This is Sovrun, your guide to financial literacy. Today, let's talk about why your diversified portfolio might not be as safe as you think. In 2022, something broke, stocks fell, but bonds, the thing that's supposed to protect you, fell too. The classic 60-40 portfolio had its worst year in decades. The reason? Correlation. When two investments that normally move apart suddenly move together, your safety net disappears. Correlation measures exactly that, how two investments move in relation to each other. Correlation is just a number from -1 to +1. +1 means two things move perfectly together. -1 means they move perfectly opposite. And 0 means there's no pattern at all. Think of dance partners. Some move in perfect sync, that's +1. Some mirror each other. When one goes left, the other goes right, that's -1. And some are dancing to completely different music, that's 0. The best portfolios are like a dance troupe, where not everyone does the same move at the same time. Here's how the scale works in practice. +1.0 means two assets move perfectly together. -1.0 means they move perfectly opposite. 0 means no relationship at all. Let's look at real numbers. Stocks and bonds have a correlation of about -0.30. They tend to move in opposite directions. That's why bonds are in your retirement fund. Two tech stocks, about +0.85. They move almost identically, so owning both doesn't give you much diversification. And stocks and gold, just +0.05. Almost completely uncorrelated. Gold really does march to its own beat. Let's put this on a scale. The NASDAQ 100 has a 0.90 correlation with the S&P 500, nearly identical. International stocks, 0.75, still pretty linked. REITs sit at 0.60. Gold, just 0.05, almost no connection. Managed futures, right at 0. They're the ultimate diversifier. And US bonds, historically, -0.30. They actually move the opposite direction. That negative correlation is why bonds have been the classic hedge against stock market drops. The 2008 financial crisis was a brutal lesson in correlation. Before the crash, mortgage-backed securities were thought to have low correlation with each other. The idea was that housing markets in Florida, California, and Nevada wouldn't all crash at the same time. They were wrong. When the bubble burst, correlation spiked to nearly +1.0 across the entire mortgage market. What was supposed to be a diversified portfolio turned into one giant bet. It destroyed Bear Stearns, Lehman Brothers, and nearly the entire financial system. Here's what most people get wrong. Correlation does not mean causation. Ice cream sales and drowning deaths both go up in summer, but ice cream doesn't cause drowning. And here's the bigger trap. Correlations change. What was uncorrelated last decade might be highly correlated now. Diversification works until everyone panics. Then everything moves together. And correlation isn't just for investing. It's used in medical research for drug interactions, psychology for behavior patterns, and climate science for temperature and CO2. Follow Sovrun for more financial insights.